welcome to all our clients tuned in this morning. I noticed that we have many new visitors to this webinar, so a very special warm welcome to you. Thanks for joining us. My name is Monique Charland. I am a professional accountant and a specialist in business advisory and tax law, specifically for the small and medium enterprise sector. Also a franchise expert and founder and CEO of the National Franchise Company Business Accounting Network, or better known as BAN. And as the first and leading professional accounting, business advisory and tax franchise in South Africa, and in our capacity as accountants and being business owners ourselves, we have identified key areas where smaller businesses and their owners miss out on a guaranteed way to mitigate compliance risk, improve and create wealth worth having, and to use the strategic advantage and competitive edge that big business does naturally. And so we would like to do some investing of our own by showing you, by way of our complimentary monthly business webinars, the common mistakes we see business owners make and how to avoid them. So we do hope to have you tuned in every month this year. This morning's webinar will provide you with an overview of the 2019/2020 budget, in other words, this year, ending February next year, which was announced in Parliament last month, as it relates to business, which is companies and sole proprietors, as well as to individuals, giving you both the highlights of the country's budget as well as the tough lowdowns the country is busy going through. Our host for today's webinar is the proficient webinar host, Shane Webb, who is based in Howick in KwaZulu-Natal. And I'd like to introduce our presenter today, Madeleine Pretorius. Madeleine is a BAN franchise owner based in Paarl in the Western Cape, and together with myself heads up technical training within the BAN franchise group. Madeleine qualified as a chartered accountant in 2012 after completing her psycho articles at PricewaterhouseCoopers in Gauteng, and is a registered CA with the South African Institute of Chartered Accountants. Before we get started, just a little housekeeping. We would love to hear from you, so if you have any questions during the presentation, please type them into the question box in your control panel on the right-hand side of your screen, which Shane has already showed many of you who have tuned in earlier. You may address questions at any time during the presentation, which will be addressed by Madeleine. To obtain a copy of today's slides, they can be downloaded, as Shane has already mentioned, but we will have a copy of the webinar on BAN's website later on today at www.ban.co.za under the Events tab. Next month, on the 24th of April, we will be reviewing tax risk, which is an incredibly interesting webinar, protecting you and your business. So we hope to see you next month on the 24th of April. And without any further ado, I'd like to hand over to Madeleine. Thank you, Madeleine.
Thank you, Monique, for your lovely welcome. Good morning, everyone, and thank you so much for joining our business webinar today. The 2019 budget was eagerly anticipated by the public and analysts alike because of the uncertain economic and political times we find ourselves in, as well as this being the maiden budget speech for our new finance minister. To put it in context, the 2019 budget speech came at a time of low economic growth, the threat of a further credit rating downgrade, a very high government wage bill, a frighteningly high unemployment rate, and numerous reports of the mismanagement of state-owned enterprises. South Africa's consolidated deficit is ever increasing and is estimated to increase to about 4.5% by the end of this fiscal year. And if we look at it from a tax or a revenue collections point of view, the projected shortfall has now been increased to about 15 billion rand. And this is mainly attributable to a decline in income tax collections from both a corporate and personal point of view. And this is mainly due to economic weakness and poor tax administration from a SARS point of view. So as a result of this year's budget speech is all about restoring public and investor confidence. And therefore, it revolves around increasing the efficiency of tax collection and revenue generation, rather than just across the board increasing tax rates. The 2019 budget also continues with the trend of prioritizing learning and culture, social development, health, as well as community development. What's interesting to note is that in order to limit the negative impact on our economic growth, as I've mentioned, there was a decision taken not to increase the tax rates in any category, whether it was normal income tax or VAT. So instead, they are trying to or planning to increase collections by not adjusting for inflation. And in a couple of slides, we will look at how that has been done. The budget speech is also not as tax heavy as such as in prior years. So we will look at the main highlights today. And a very interesting thing to note is this shortfall of 15 billion Rand in the revenue collections from SARS, almost half of that additional 15 million Rand can be attributed to higher than expected VAT refunds. So that's quite interesting and a little bit of a positive, because there have been numerous complaints in the past years. Maybe as business owners, you are aware of the fact that VAT refunds from SARS have been very sluggish and almost very difficult to get out of SARS. And with all the complaints and the comments and the matters that have been raised, SARS has addressed this, and there has seen almost an increase in the efficiency of VAT refunds. And this has actually generated almost a shortfall for SARS. But on the other hand, the Minister of Finance just did note that the positive side to this is that cash is going back into the economy. Let's have a look, first of all, at the major tax changes or key points for individuals and trusts. Now, from a business point of view, it's important also to be aware of the budget changes to individual tax rates and the tax tables, because that will directly affect your monthly PAYE calculations if you do have employees in your business. So as you can see, the tax table or the tax rate table for individuals has not changed from the prior year at all in terms of the tax rates. So it still starts at 18% and goes up to a maximum of about 45% if you are a high income earner. However, what SARS has done is it hasn't changed these brackets, these income brackets. And what that does is it then doesn't adjust for inflation, and something called bracket creep comes into play. In other words, if employees do receive a salary increase, most often in terms of inflationary increase, they will actually be paying more tax in real terms. Because if you are an employee and your salary was at possibly almost at 305,850 Rand, if you now receive an inflationary increase, it'll kick you into a higher tax bracket where you will be paying 31% of tax. But because the tax brackets haven't been adjusted, that will obviously affect you directly. So you can see that instead of adjusting the tax rates upwards, SARS has increased their revenue collection by not adjusting the brackets, but anticipating that employee salaries will have gone up. This tax rate table affects individuals or natural persons as well as special trusts. For normal trusts, a tax rate of 45% is still applicable, and there hasn't been any change to that. If we look at the tax thresholds and tax rebates for natural persons, you can see that there has been a very slight increase to these. So there has been a little bit of relief. But if you do the calculations, you can actually see that it's almost only just over 1% of an increase, which is very much below inflation. So once again, SARS has provided a slight relief, but they are expecting revenue collections to increase due to an inflationary increase not being reflected in these thresholds and rebates. So if you're an individual below 65 years of age, your new tax threshold will be any income earned of 79,000 Rand. And that obviously increases slightly as you get between the 65 to 75 age bracket and then age 75 and over. From a tax rebate point of view, all natural persons will receive a primary rebate of 14,220, so it's 14,220 Rand. And that, once again, as I've mentioned, is a below inflation increase from the prior year. And interesting to note also is there are very small changes also to your secondary and almost third tax rebates for persons aged 65 to 75 and then persons aged above 75. And those individuals are typically earning retirement or annuity income, and their SARS doesn't expect them to actually have an inflation increase in the amount that they earn each month. So they will receive a slight relief. Transfer duty is payable on transactions in respect to the acquisition of property on or after the 1st of March, which are not subject to VAT. So if you buy or purchase a residential property and you do not pay VAT on it, transfer duty will be applicable. And it's interesting to note that in the budget this year, this duty-free threshold has been increased from 750,000 Rand to 900,000 Rand. And this is purely to provide relief for lower and middle income households, in other words, for them to afford residential accommodation. The actual rates of transfer duty and the brackets after that have not changed at all. The medical aid tax credits remain unchanged from the prior year. So you will still receive 310 Rand in a medical tax aid credit if you contribute to a medical aid in respect of yourself as a taxpayer only. 620 Rand, which is double that in respect of the taxpayer and one dependent. And for any additional dependent after that, you will only receive 209,000 Rand in medical aid tax credits. So that is the same as last year. And the interest exemption is also unchanged from last year. So you will receive 23,800 Rand per year of assessment for any individuals aged under 65 years of and 34,500 Rand for individuals aged 65 and over. And this is in line with the National Treasury. Their policy is to encourage the use of a tax-free investment rather than a normal interest-bearing investment, because they would like to phase out the interest exemption in the future. Further proposals relating to individuals that have come through from the budget is that there will be an update in the Employment Tax Incentive Act to align the wage regulating measures with the new the National Minimum Wage Act, so that those two are speaking to each other. And there is also going to be a review of the foreign employment income tax exemption for South African residents. Now, for those of you who might not be aware, from the 1st of March 2020, South African residents who spend more than 183 days in employment outside the country, so in foreign employment, will be subject to South African tax on any foreign employment income that exceeds R1 million. So if you receive foreign employment income, whether it is cash salary or other benefits, up to R1 million will be exempt, but after that you will be taxed on the normal individual tax rate table. And this has been an amendment from prior years where this was actually exempt. So with the current budget proposals, they are going to refine this slightly to prevent the monthly withholding of income tax both in South Africa as well as in the foreign host country. So the proposal is that South African employers will be allowed to reduce their monthly local PAYE holding by the amount of foreign taxes withheld on that employment income, so that there isn't almost a double deduction. However, before this is being implemented, there will be workshops and opportunities to consult and for you to give comments. So if this is applicable to you, in other words, if you are an employer and your employees are doing business in foreign countries and receiving foreign employment income, please look out for these amendment bills so that if there are comments necessary and you would like to make them, that you have the opportunity to do so. There are also certain retirement reforms being proposed. These include a review of the exemption relating to annuities from a provident fund or provident preservation fund. So currently on retirement, any contribution to a retirement fund that did not qualify for deduction in your calculation of your taxable income is tax exempt. However, this is proposed to extend now to provident funds as well as provident preservation funds if you receive an annuity from such funds and you made any contributions on or after the 1st of March 2016. They are also going to review the tax treatment of bulk payments to former members of closed funds. So any unpaid amounts on deregistered retirement funds could possibly be tax-free payments if these meet certain criteria. There will also be a review of the tax treatment of surviving spouse pensions in order to ease the cash flow burden and the tax debt for the surviving spouse. And they will also look at the review of the non-resident employer registration requirement. So currently, if you are a foreign employer, you must still register with SARS as an employer, regardless of whether you are obliged to withhold PAYE for your employees or not. And this will now be reviewed to determine if you could qualify, or these certain types of employers could qualify from exclusion or for exclusion from this registration requirement. Let's move on to the corporate tax rates and any changes to those. As you can see, I've mentioned in a couple of slides back, None of the corporate or individual tax rates have changed. So you can see that for companies and closed corporations this year, it will still be a basic rate of 28% for corporate tax. If you are qualifying for a small business corporation, you can see that there has been a slight change in the tax tables. However, if you look at it more closely, the tax rates have not changed at all, and it is merely this initial tax-free portion or the tax-free threshold that has actually gone up slightly from 78,150 Rand to 79,000 Rand. Now, for those of you who are not sure, a small business corporation has certain requirements before you can actually qualify as a small business corporation and then be subject to these tax tables instead of the 28% flat rate on corporate entities. So what are these primary requirements? To qualify for a small business corporation, all the shares in the company or in that company are to be held by individuals, none of whom hold shares in any other company other than listed shares, unit trusts, and shares in certain tax-exempt entities. The gross income of the corporation may not exceed 20 million Rand for the year of assessment. Not more than 20% of the gross income of the company may comprise investment income, and income from rendering a personal service is defined, and the company may also not fall within the definition of an employment company or a personal service provider. Micro businesses are typically businesses with a turnover less than 1 million Rand. And to be able to register as a micro business, you obviously need to meet certain criteria, and you also need to apply for that from a SARS point of view. As you can see, the table applicable to micro businesses in terms of tax rates has not changed in this budget either. So the thresholds as well as the rates have not changed. So up to the first 335,000 Rand of taxable income will be tax-free, and it could go up depending on the amount of your taxable income to about 3% of tax for micro businesses. From a capital gains tax point of view, the rates have once again remained unchanged. So if you earn a capital gains tax, if you earn a capital gain, or you sell an asset and you earn a capital gain in that tax year, individuals and special trusts will still have an effective maximum tax rate of 18%, companies 22.4%, and other trusts 36%. And your annual exclusion for natural persons remains at 40,000 Rand. So you can see that there hasn't been a significant change in terms of the rates for this budget speech. Moving on to indirect taxes, last year we saw quite a significant change in terms of the increase of the VAT rate by 1% from 14% to 15%. And in order to provide a little bit of relief for consumers, the Minister of Finance has actually changed or included various extra products, including white bread flour, cake flour, and sanitary pads to be zero rated for VAT purposes. And this will be effective from the 1st of April 2019. The fuel levy is set to increase at 29 cents per litre of petrol and 30 cents per litre of diesel. If we look at the breakdown of that 29 cents per litre of petrol is made up of 15 cents per litre on the general fuel levy, 5 cents per litre on the road accident fund levy, and the introduction of a carbon tax on fuel amounting to 9 cents per litre. So the carbon tax bill is now going to be implemented this year with an effective date of 1 June 2019. And what this carbon tax effectively does is it gives effect to the polluter pays principle. In other words, it prices greenhouse gas emissions, and it aims to ensure that businesses and households take these carbon emission costs into account in their production, consumption, their investment decisions, and hopefully it will assist in reducing carbon emissions and ensure that South Africa meets its commitments under the 2015 Paris Climate Agreement. And this carbon tax bill will be reviewed after 3 years. And if we look at that increase in the fuel levy, as well as the introduction of the carbon tax bill, the proposal is to raise an additional 1.3 billion Rand of revenue. There will also be an increase on the duties on alcoholic beverages and tobacco products between 7.4% and 9%. And the sugar tax will increase to 2.21 cents per gram in excess of 4 grams of sugar per 100 mils, with effect from the 1st of April 2019 as well. And the tyre levy still remains at 2.30 per kilograms per tyre. From the budget 2019, we can also see various incentives coming into play. And most notably, these are the Energy Efficiency Savings Tax Initiative, as well as the Employment Tax Incentive. Now, some of you might be aware of the Employment Tax Incentive, which is a program to incentivize the employment of young people in the workforce. This has been extended by 10 years in 2018, and the eligible income bands will also be adjusted upwards to partially cater for inflation. So from the 1st of 2019, what this means is that employees will now be able to claim the maximum value of R1,000 per month for employees earning up to 4,500 monthly, where this was only 4,000 Rand previously. And the incentive value will also then taper to zero at a maximum monthly income of 6,500 Rand. When we look at the Energy Efficiency Savings Tax Initiative, this was introduced in November 2013 to offset the tax burden on industry from the introduction of the carbon tax. So this comes into play a little bit more now because the carbon tax bill has actually come into effect this year. And so this incentive might actually play a more important role. It was due to expire on the 3rd of December 19, but the bill is now to extend it to the end of December 2022. And what does it actually do? It provides companies with a tax deduction for energy efficient investments like solar energy, water saving programs, where you are contributing to environmental goals and reducing energy costs. So they will also in 2019 review the design and administration of the incentive to make it more user-friendly, to improve its ease of use, its effectiveness, as well as its overall economic impact. From a tax administration point of view, the legislative provisions relating to tax compliance certificates will be updated to include certain system requirements. And there has also been a move to adopt the model mandatory disclosure rules and non-compliance penalties from an international standard point of view. What this relates to, for those of you who are not aware of these, let me explain. The Organization for Economic Cooperation and Development has a set of common reporting standards, and this standard is used for the exchange of information between countries. And typically this is used to make sure that there is tax and revenue compliance between countries and also taxpayers that have business dealings within South Africa as well as internationally. Now, what has come to light is that there are certain international offshore structures and arrangements that are designed in such a way that the taxpayers get around, or the business owners get around, the financial accounting or reporting requirements of these standards, because they don't necessarily want to disclose to SARS or other tax authorities what their business dealings are, obviously so that they can get around the tax requirements. So it is now proposed that the OECD's mandatory disclosure rules are now implemented in South Africa as well, and together with this, similar penalties that are enforced internationally, just to counter those structures and arrangements that are put in place to obviously not be compliant. So what does this mean for South Africans going forward? Although South Africa is facing a tough fiscal year, there is room for growth. And the South African government has pledged its support to small business. Specifically, the government allocating 481.6 million Rand to the Small Enterprise Development Agency to expand the Small Business Incubation Program. So this is specifically to aid startup companies. And you probably would have noticed a trend throughout the budget, and what we've discussed today is that there is a shift from revenue collection as such to rather restoring the public's confidence in the credibility of the revenue collector, in other words, SARS. And some of these proposals include prioritizing the appointment of a permanent commissioner in the coming weeks, reinstating the SARS large business unit, which was in the past very effective in sorting out corporate queries, as well as increasing the efficiency of tax collections by focusing on enforcement, embracing new technology. Hopefully our webinar today assisted in making sense of some of the tax and legislative changes in store for South Africans and businesses going forward. As you can see, it hasn't been very tax heavy this year, but by taking note of the points that we discussed today, it will assist you and your business going forward and making sure that you. As Monique mentioned in her introduction today, we would like to invite you to join us for our next client webinar or business webinar, which is to be held on the 24th of April in our usual time slot of 9 to 10 o'clock in the morning. And we will be looking at tax risk and how to protect you and your business. Shane and and our listeners, I'd like to open our virtual floor for questions.
So a question from Corinne, please mention the value for ETI again.
The employment tax incentive. Okay, let me, I'm actually going to go back to that slide. Of your claim is R1,000 per month for those employees earning up to 4,500 Rand monthly. And this has changed or increased from 4,000 Rand previously. And your maximum incentive or maximum monthly income for the incentive value is 6,500 Rand. Corinne, I hope that provides you with the information you were looking for. I'm just going to read out Michelle's question. My husband earns foreign income. He transfers funds to my account every month for household expenses and payments. Do I declare this money in my personal income tax? Well, Michelle, I suppose it depends on how your structure or your household structure is set up. But if he is transferring funds into your account, and that bank account is in your name, then I suppose you could see it possibly as a donation. Now, that would actually look at the donations tax rules. Now, there is a tax-free portion or a threshold on donations tax, after which 20% of donations tax is payable. However, there are certain rules regarding to transfers within among spouses. So before I can just answer that question, I wouldn't necessarily think that you have to declare that as income. It might fall under certain types of tax-exempt income or donations income, but that would be on a case-by-case basis, and we'd actually have to look at your case and look at all the almost can I say technical aspects around it to see how exactly it should be treated in your personal income tax return. Shane, I see that you've also posted a question from Corinne. Corinne asks, is there not some age limit on ETI as well? Corinne, I am aware of the fact that there is one, yes, because I know it talks mainly at employment of youth. However, we would look at that in terms of the ETI specifically. And if you'd like, you can contact me or Ben, and we can actually discuss exactly how the ETI criteria works. From and two, has the ages of ETI changed, and what is the requirement for foreign staff to be registered for tax and UIF? Okay, Sheikh, as I mentioned to Corinne, in terms of the ETI age limits, offhand, I'm not aware of what the age limits are, and there has been no mention of the ETI changes from a budget point of view in terms of age limits. That we will have to look at in terms of the employment tax incentive bill or documentation itself to see whether there have been any amendments coming through. But please feel free to contact us, and we can have a look at that and send you the information personally. And then you asked, what is the requirement for foreign staff to be registered for tax and UIF? Now, in terms of foreign staff, usually as an employer, you would need to register with SARS as an employer, regardless of whether you are deemed to be or supposed to withhold PAYE or not. Now, there are many requirements around that in terms of withholding of PAYE and UIF. There are certain thresholds one needs to look at, and number of hours being worked for your staff, and all sorts of things like that. So I would actually also like to take a look at that in detail for you, rather than giving you almost like a blanket answer and it being specific to your business, if you don't mind. Please feel free to send me an email, and I can definitely discuss that with you. Celeste asks, if someone works out of the country for less than 183 days per year, are they exempt from tax even if they earn over R1 million? Well, Celeste, in the prior tax, tax laws, there was a certain section 1010, which allowed for the exemption of foreign employment income if you did not meet the physical presence test. And there are certain requirements of the physical presence test in terms of the tax legislation. That has now been changed in terms of an amendment bill during the 2018, calendar year. So the proposal now is that from 1st of March 2020, as I mentioned, if you now earn below R1 million, that will be exempt. But over R1 million, you will have to pay tax on that foreign employment income. So I suppose you would have to look at the years of assessment in which you earn that foreign employment income to see which provisions in terms of the tax legislation apply. So obviously, as soon as the change is made, you would need to apply the new provisions. But in years that you earn foreign employment income on the old provisions, in that tax year of assessment, you would then obviously be able to apply the exemption. I don't necessarily want to say if someone works out of the country right now, we would also have to look at your situation on a case-by-case basis. Celeste, I hope that answers your question.
Michelle's question with regards to her husband's foreign income earnings. In this case, the husband needs to obviously register as a taxpayer both in South Africa, certainly, because South African law requires that all local as well as foreign income is declared on the South African tax return. So he pays tax on that income. The fact that Michelle is receiving some of that money in her account will be completely tax-free, simply because, one, he's paid the tax on the money and it can't be taxed a second time. And secondly, most importantly, is that they are spouses. So because they are married, there will be no tax consequence at all in Michelle's case. By receiving this money, it will go towards household income and so on and so forth. So there wouldn't be there can't be a donation between spouses. However, there would be a donation between, say, for instance, a parent and their child, but not between spouses at this stage. And also the other question, I think, Madeleine definitely answered that correctly from Sheikh. What is the requirement for foreign staff to be registered for tax and UIF? Well, anybody working in South Africa, providing services in South Africa, does need to register for tax in South Africa. And if they are employed, the employer does need to ensure that those employees, foreign or local, irrespective, are registered for tax. I think that was just really the input I have at the moment from my side, Shane.
Through your initial question again, I think I misunderstood your question, and because you were asking if someone works out of the country for less than 183 days, in other words, where they do meet the physical presence test. So in that case, if you do meet the physical presence test and you were in the country for less than 183 days, or sorry, outside of the country for less than 183 days, then you are seen as a South African resident and a South African taxpayer. In other words, you will have to pay tax on your worldwide income, whether it's earned in South Africa or abroad. And therefore, that 1 million rand threshold tax exemption will not apply to you. You will have to pay tax on all of your income. Because you are seen as a South African resident, you do meet then the physical presence test. Celeste, with regards to your second question, if you decide to leave the country, how do you go about unregistering yourself as a taxpayer or tax resident? Well, from what I understand is there are various ways of doing this. One is to do almost like a financial immigration, in other words, cutting your ties as a South African resident financially completely. And there are certain requirements to do this with regards to SARS. And the other way to do it is actually to do a full-on immigration and to make sure that all your connections to the country are cut completely. Because there is quite, from the documentation that I've read, there is quite a bit of a grey area, and it will really impact on employees who are still South African residents as such, but who mainly work overseas, in other words, where the exemption would have applied to them previously. So you would have to look at your tax affairs and make a clean cut to make it almost safe for yourself that you don't have tax being paid both in as far as I'm aware, I haven't noticed any specific budget proposals with regards to non-profit organizations or religious organizations. And from a SARS or legislative point of view, I would rather actually like to do a lot more research before I answer your question. If you are happy with that, I would like you to please send me an email. You can send an email to BAN, which will then come through to me, and I will be happy to do some research for you.
Yes, I would agree with you there, Madeleine. I don't think we have enough information to be able to answer this question because under Section 10 of the Income Tax Act, which covers exemptions for certain non-profit organizations and non-profit companies, and there are certain criteria. For example, does it fall within a public organization or not, this particular non-profit organization? And there is a list of what public organizations are. It is effectively in the interest of a public organization or in the interest of the public, so to speak, And if this non-profit organization or non-profit company falls within that characteristic or that definition, one can apply to SARS for an exemption under Section 10. But we would certainly need a lot more information as to what this non-profit organization or religious organizations actually does. So, Sheikh, you're most welcome to send your query with more detail in that regard to admin@ban.co.za, and we shall attend to it for you. Thanks, Sheikh. Thanks, Shane.
Says, there has been much buzz in the news regarding religious body leaders living lavish lifestyles from proceeds donated to churches from churchgoers. Oh dear. Thanks, Alison, for your observation or contribution. You further mentioned that the President made mention that SARS will be investigating various NGOs with regards to the Joshua Generation Church and the proceeds not being taxed.
Oh, that's quite interesting. Yes. Yeah. I just certainly haven't seen anything in the budget with regard to that proposal. They're obviously looking at this, but as far as I am aware, whether the organization is registered as a non-profit organization or whether it's registered as a non-profit company, and it does qualify under Section 10 exemption for tax purposes, any payments to the administrators or any staff or employees of that organization is still subject to PAYE. That is not exempt. So I'd be interested also to find out how these monies are actually being siphoned from the non-profit organization to some of the how does it actually enrich the lifestyles of some of these churches and religious bodies if it's not being paid by way of a salary, which would have been taxed for PAYE purposes, and if it does qualify as a non-profit organization or a non-profit company, the constitution of those non-profit organizations, you cannot distribute any profits or proceeds at all to any of its members. So obviously they're contravening the actual constitution of a non-profit organization or a non-profit company. So it'll be interesting what comes out of this later on in the year. So certainly I think Madeleine and I will be tuned to what will happen going forward.
Yes, thanks, Alison. Thank you for your input.
Yes, that's very interesting. Thanks, Alison.
Will the 1 million rand of foreign income be pro rata if it only relates to income for a portion of the year? And B, I assume for earnings over 1 million rand, only the portion above 1 million rand will be taxable. Keith, I would rather actually like to look at this new amendment in detail. I think it is actually still under discussion. They are still holding consultations and amendment bills. However, I would think, just thinking about how the tax usually works, I would think that if you do only earn foreign income for a portion of the year, it could be pro rata, but then you would also have to go and look at your physical presence test and the requirements of that, because that does look at a 12-month period. And then in terms of the exemption of over 1 million rand, I assume for earnings over 1 million rand, only the portion above 1 million rand will be taxable. Yes, it would most probably be your whole 1 million rand threshold then.
Yeah, that is the threshold. So it's any earnings above 1 million rand that will be taxable.
Yes.
That's correct, yeah.
And for your questions, for your interaction, and thank you, Shane, again, for our technical support. Thanks also to Monique.
Thank you very much, Madeleine, and I concur. Thank you. Thanks very much, Madeleine, and we hope to see all our clients tuned in next month. Very interesting webinar on tax risk and how to protect you and your business, especially following on what Madeleine has just spoken about with regards to SARS nailing down on compliance rather than, and obviously increasing their revenues rather than increasing the tax tables this year. So it's going to be quite interesting for a lot of the business owners and individuals going forward. So I think tax risk is going to be an incredibly important webinar to tune in for business owners as well as individuals, because it does affect individuals to some extent as well. Thank you very much, Madeleine, for a wonderful presentation as usual. And thank you very much, Shane, for a fantastic hosting as usual. I'd like to say goodbye to everybody and see you on the next webinar next month.